Joining us now, Jordan Jackson, JPM Asset Management Global Market Strategist. Jordan, part of that call is, 2%, 1.7% on the 10-year. It feels really hard to get to that level right now when you're seeing such a decline in yields. But how do you square low yields and what you do in the equity market?
Well, as highlighted, I think it certainly spells a bit of concern or trouble for the growthier parts of the market, right? And I think that's where the vulnerability lies at 115, between 120 on yields. Any sort of backup 20, 30 basis points could certainly spell danger for the growthier parts of the market. And I think it also plays into sort of the value-orientated parts of the market in favor of value, but not just all types of value, because we know all value is not created equal. And I think the move that we've seen in markets so far year to date is a reflection of that, right? Energy and financials are the top two of the top two of three performing sectors so far year to date, whereas consumer staples and utilities are sort of laggards. And so, I think you want to be positioned sort of in the cyclical value parts of the market. But again, I think, it's a difficult call to make, and where yields are at is certainly puzzling, I think, a lot of economists as well as investors as well.
Yeah. Jordan, yields have been tracking lower for a while now. This isn't a new phenomenon. They've been going lower and lower and lower. We had a kind of a really big move down earlier on in the session. We're getting near some big technical levels. 1% isn't that far away. How convinced are you that we're near the trough when it comes to the 10-year?
Well, I do think that we are in a position where over the next couple of weeks here, potentially till the end of September, that yields are going to stay pretty low. And I think it's partly reflective of the supply and demand dynamic that we're seeing in the market. Obviously, we know stimulus has come by the way of the drawdown on the Treasury general account. So the Treasury isn't issuing as much debt, and they're already talking about reducing auction sizes. In a world where you're flush with liquidity, on the demand side, you're still seeing very, very strong demand for bonds. And so I think that dynamic could continue to play out again through August and into September until we get some sort of resolution on the debt ceiling.
So Rich Clarida was talking earlier to Adam Posen, some of the headlines that came out. Risks to his inflation outlook to the upside, but still sees the conditions for rising rates could be met by the end of 2020. Do you think the market's prepped for an end of 2020? Sorry, end of 2022. My bad. End of 2022.
I think so. When I think towards the end of 2021, again, I think yields sort of are released from this technical hold sort of towards the end of the third quarter and allow them to realign themselves with the fundamental picture as we move through the fourth quarter and into the first half of next year. Remember, this is also going to be at a time where the Fed is going to be stepping off the gas in terms of its asset purchases. And so you have an environment where hopefully, that the demand side obviously is going to remain robust. You'll start to get some supply coming back in, but then the Fed sort of hand of demand is going to start to pull back as well. And I think that's when yields can start to align with fundamentals and start to move higher. It's just that yields at 112, they're currently signaling a permanently impaired economic trajectory over the course of 2022 and 2023. And that's just not what we're seeing from a fundamental perspective. If we look at things like the copper gold ratios, equity market valuations, commodity positioning, all these other more growthier signals are suggesting that bond yields should be much higher than where they are today.
Jordan, let's take another tack on this. Stay-at-home stocks have had a tough time recently. And I'm wondering whether, with the Delta variant spreading in the way that it is at the moment, whether that trade is worth another look.
I think it's going to be a start and stop. It's going to be a bumpy road. We don't necessarily know. No one necessarily knows how things are going to play out here. I think you need a balance between both. I think you need a balance between the reopening trade, the reflation trade, which certainly plays well into the cyclical value parts. But I think you also need to complement that with the still structural defensive growth story. Again, this is going to be a start and stop reopening type of process. And so we haven't signaled the all clear. And I think with this environment, investors will need to sort of rent cyclical value and own structural growth in this environment.
Does that view also apply regionally? Is that still is there room to buy Europe as the value and then also buy the U.S. as growth?
I think so. But I think, getting in now could feel a little bit early. There's still a lot of starts and stops when we look at the Eurozone. I think the UK is sort of a bright spot in terms of its vaccination pace, which has been very strong. But I think broadly within the Eurozone, again, there's still some starts and stops, some concerns there. I think specifically within Japan, obviously, are dealing with another wave. And so it could feel a little bit early getting into sort of your developed market names today. We could still see a little bit of U.S. exceptionalism over the next couple of weeks here. But again, I think as we move through the fourth quarter, as that global sort of cyclical trade comes back into play, I think that's where you do want to start to be looking for opportunities. And then I think in the first half of next year, that's really where EM starts to become a bit more interesting. Again, as they get over their COVID curves, obviously, more recently they're dealing with higher levels of inflation, and so central banks have to be a little bit more aggressive. But I think as we move through the first parts of 2022, that to change. And so a little bit more as we move through the back half of this year into next year, a good mix of U.S. and gradually moving into the international space, I think makes a whole lot of sense.
What do I buy to introduce portfolio protection? On both sides, I'm curious. A lot of people have been piling into tips, trying to kind of hedge the inflation risk on the upside. But that trade looks like it's going to be a really tough one, given where we are with valuations. Where else can I build inflation protection into my portfolio? But where on the other side can I also build downside protection in as well? How do I construct a portfolio, given where equity valuations are right now, that gives me kind of some optionality when it comes to inflation, but also some downside sort of protection if the market decides to turn?
It's a great question. I still think you need a little bit of duration in that type of environment for protection, right? I still think bonds are still sort of the hedge to the equity markets. I do think that you probably still need some more hedge type of equity products, sort of put strategies if you have to provide some downside protection. And I think more broadly, when we look towards just the bond market and protection and hedging against inflation, investors really have to ask themselves, do I want to hedge against inflation or do I want to outperform inflation? Now, look, I think, tips are generally up about, less than about 4 to 5% so far in the year, but equity markets are up in double digits. And so when you're constructing a portfolio, you really have to be cognizant of again, you constructing a portfolio that's going to outperform in inflationary environments, because I don't think just hedging is going to get you where you need to be. And so it's a collection of equity exposure. Obviously, I still think the value trade, as I mentioned, has some rooms to run. And then I think some of the more commodity sensitive parts of the market, when you look at industrials, materials, are a way that you can play that as well.